Welcome back to the channel. As we move closer to the end of 2025, many dividend investors are starting to feel uneasy about SCHD, a fund that was once considered the undisputed champion of dividend growth ETFs. Throughout this year, SCHD has watched several of its closest competitors leave it behind in terms of share price performance. Vanguard's VIG has surged ahead, DGRO has displayed steady strength, and even Vanguard's high-yield ETF, VYM, has delivered better returns for most of the year. Because of this, countless investors have reached out with frustration, wondering if something is fundamentally wrong with SCHD or if now is the right moment to switch their money into funds that seem to be gaining more traction. The truth is, whether you should sell SCHD or continue holding it depends heavily on your goals, your financial timeline, and how you interpret the direction of the overall market. This video is for informational purposes only and is not financial advice. Always do your own research or consult a professional before making any investment decisions. SCHD's recent slump didn't just appear out of thin air. The primary source of its struggles began earlier this year during the ETF's annual reconstitution, the time when SCHD evaluates its holdings, removes companies that no longer meet the index rules, and adds new companies that score well on their factors. SCHD follows the structure of the Dow Jones U.S. Dividend 100 Index, which has several strict eligibility criteria. Companies must have paid dividends for at least 10 consecutive years, maintain a float-adjusted market capitalization of at least $500 million, meet minimum liquidity standards, and cannot be REITs, MLPs, or other alternative investment types. After screening for these requirements, the index evaluates companies based on 4 key factors: cash flow to total debt, return on equity, dividend yield, and 5-year dividend growth rate. Once the top companies are selected, the holdings are weighted using a modified market cap system, with no single company allowed to exceed 4% of the fund. This year, during SCHD's reconstitution, one sector ended up dominating the list of qualifying companies: energy. Because of this, SCHD added more energy stocks than any other sector, surpassing consumer staples, materials, and nearly everything else. On paper, this didn't seem like a bad direction. Energy companies traditionally offer high, stable dividends, especially compared to fast-growing sectors like tech. Since utilities and energy businesses don't grow rapidly, they often compensate for slower growth by distributing higher dividends to attract investors. The problem for SCHD was not the quality of these companies, but the timing. Shortly after SCHD increased its exposure to energy, the entire sector began to underperform. If you look at the Vanguard Energy ETF, VDE, you'll see that energy stocks started falling around April, only weeks after SCHD loaded up on them in March. Because of this, SCHD ended up with roughly 20% of its entire portfolio sitting in a sector that had one of its weakest years. Meanwhile, VIG had only around 2% exposure to energy, and DGRO around 5%. Naturally, those funds had far less weight dragging them down. That single rebalancing decision created the majority of SCHD's underperformance for the remainder of 2025. So the issue isn't that SCHD is broken or poorly constructed. It simply had the misfortune of overweighting a sector that went on to struggle for months. This brings us to the big question: should investors sell SCHD and move into something performing better? The answer completely depends on the type of investor you are. If you want stronger short-term share price growth and prefer to ride the momentum of sectors like technology and financials, then VIG or DGRO may look far more attractive. If your focus is total return over the next few years and you want exposure to the sectors leading this bull market, then switching away from SCHD could make sense. On the other hand, if you're a long-term income-focused investor, then SCHD still shines in many areas. The fund holds a large number of dividend aristocrats, stable, reliable companies with at least 25 straight years of dividend increases. When comparing SCHD to an ETF like NOBL, which tracks dividend aristocrats directly, the price movements are often very similar. That's because both funds include companies with strong balance sheets, consistent cash flow, and a proven history of rewarding shareholders. One area where SCHD remains exceptionally strong is dividend growth. According to data from Seeking Alpha, SCHD's 5-year dividend growth rate is 10.38%, and it has consistently stayed above 10% for many years. VIG's dividend growth rate, while also impressive, is slightly lower at 9.73%. On top of that, SCHD offers a starting yield of about 3.8%, while VIG offers around 1.6%, less than half as much. This means that SCHD pays more upfront and also grows those dividends at a faster pace. Over the long term, the compounding effect of higher dividend growth combined with a higher starting yield can produce dramatically different results. To make that difference clear, let's compare the two funds over a 20-year period. Imagine you invest $10,000 into SCHD and $10,000 into VIG, reinvesting all dividends along the way. Using recent averages, VIG's yield of 1.61%, dividend growth rate of 9.73%, and annual share price increase of 11.96% would result in roughly $1,372 in yearly dividend income after 20 years. Now take SCHD with a 3.8% yield, 10.38% dividend growth rate, and a share price appreciation of about 6.54%. After 20 years, that investment would generate around $5,120 per year in dividends, more than 4 times the amount VIG would produce. That kind of income difference can be life-changing for long-term investors seeking to build a steady and growing cash flow. So how should investors think about SCHD's recent underperformance? In reality, both SCHD and VIG are excellent ETFs. Neither one is a bad choice. Each serves a different type of investor and thrives in different market conditions. If you want stronger price performance during a bull market driven by growth sectors, VIG is likely the better option. If you're worried about the market cooling off or entering a recession, SCHD's energy exposure may actually help stabilize returns. And if you're focused on long-term passive income and dividend growth, SCHD still stands as one of the most powerful tools available. Interestingly, we're already seeing hints of this dynamic play out. Over the past week, the broader market has been weakening, yet energy stocks have moved upward. That's exactly the kind of environment where SCHD tends to perform better than funds with minimal exposure to energy. Until SCHD reconstitutes again early next year, bullish investors may continue favoring VIG for upside potential, while more cautious or income-focused investors may stay with SCHD for its long-term income strength. SCHD isn't falling behind because it's a bad ETF. It simply ended up overweighting a sector that struggled this year. Its long-term strengths, high dividend growth, strong starting yield, and reliable companies remain intact. Whether you stay with SCHD or rotate into VIG depends entirely on your financial goals, risk tolerance, and time horizon. Both paths can succeed. The key is choosing the one that aligns with your personal strategy. Thanks for watching. If you found this helpful, don't forget to like, subscribe, and hit the bell so you don't miss any updates. See you in the next video.